Hi, everyone.
How you doing?
Hello.
Uh, Brody,
Yeah.
Matt Binkowski,
I think he's in the bathroom.
Morgan,
Here.
Max,
Here.
Ryan,
Here.
Martin,
Right here.
Dejor,
Here.
Caitlin.
Here.
You gonna lose internet soon?
Possibly. Spectrum's coming in the between 12 and 2 to like work on it. So I'm gonna try and reconnect to my phone if it's not locked, like the Zoom.
No sweat. Bobby,
Here.
Buset,
Here.
Megan,
Here.
Jacob,
Here.
James,
Here.
Brooke,
Here.
John, Kenny.
I prefer Jack, but here.
Oh, sorry, I wrote that over here. I have my hand over it. Elias,
Here.
Brooklyn,
Here.
William Lowe,
Here.
Paige,
Here.
Noah,
Here.
Madison,
Here.
Brendan,
Here.
Joe,
Here.
Tyler,
Here.
have history. Cole,
Here.
Kristen,
Here.
Carrie,
Here.
Dave,
Here.
Nolan,
Here.
where's Nolan? Say here again.
Here.
All right, okay. Sean?
Here.
All right. Welcome, everybody. How's everybody doing?
Good.
I'm just trying to sort of put names to faces and get to know you a little bit. Even though we're online, it seems as though I'd like to get to know you a little bit. That's the thing. One of the things that I really miss is being in the classroom and being able to interact with everybody. And I'm having a hard time with that. I'm also having a hard time with the fact that my wife is telling me I should be able to do laundry and get dinner ready even though I'm working, you know? Does anybody have questions? All right. So let's pick up where we left off the other day. Are you seeing the PowerPoint?
Yeah.
I think this is where we left off. I might be wrong, but so we started chapter 1. And what I'm going to do today is talk to you about his lecture on chapter 1 and look at these PowerPoint slides and at some point put you into groups to do the end of chapter problems, and then we'll come back. So, why are we here? Why are we studying financial markets? Financial markets are the means that we get money from people who have extra money to people who need money, you know? So people have extra money. They're looking for a place to get that money to earn them interest, investments. Those people need a way to transfer that money to companies that want to expand or buy new equipment or whatever, right? So we need financial markets and we need to know how they work. So bond markets, interest rates, and securities. A security is a claim on an issuer's future income or assets, like a common stock. Yeah, a common stock is you're a part owner of the company that you have stock in, right? A bond is a whole different type of animal. A bond is a debt security. So if a company issues a bond or a government issues a bond, they're actually borrowing money from you, right? So you give them the money to pay for the bond, you're really making them a loan. The interest rate is the price of money. It's the cost of borrowing or the price for the rental of funds. This is interest rates throughout the years. So we have in the light blue a short-term 3-month T-bill. This is essentially what we would consider risk-free, the 3-month T-bill, because we're quite sure it's a government, United States government issued. We're quite sure that the United States government is going to pay us back, right? So as the money growth rate rose in the 1960s and 70s, the long-term bond rate rose also. Oh, I'm looking at the wrong thing. I'm sorry. So even though these different interest rates sort of move in unison, they're often very different. Look at where they are most different. So in places where we had a lot of economic turmoil, like in the mid-90s here and starting in 2008, look at how far these things spread out. The blue is the 3-month T-bill and the gray is the corporate rate, right? Why do you think those things spread out like that? This is the interaction part of the class, okay? So this is your opportunity to become famous. Let's ask the question again. See the big jump, the big difference between the 3-month T-bill and the corporate in 2008? Why? First one to answer gets a Snickers bar.
Is it because the market crashed?
Yes, of course, it's because the market crashed, but what does that mean? What happened? What's the difference between a 3-month treasury bill and a corporate bond issued by Microsoft?
Is it because corporations needed more money during that time, so they increased rates to try and get more people to invest in them?
No.
The corporate bonds are riskier.
Yeah. Paige, say it again.
The corporate bonds are riskier than the treasury bills.
At periods of economic turmoil, right? That's exactly right. Thank you. And they, hang on, sorry. And Matt, yes, they did need more money. There was a real credit tightening. So you're partially right. It wasn't exactly what we were looking for. I'll come back to here and say, look at how far the spread is. This blue, these funds are really guaranteed. You know the government is going to pay you back. If you give money, especially in a period of real tight credit like 2008, when we're having a financial crisis, you better get a whole load of interest rate to be rewarded for purchasing that bond. It's much riskier given the economic climate. The stock market, a common stock is a share in ownership of a corporation. The share represents a claim on residual earnings and assets of the corporation. So you buy stock in a company, you become part owner of a company. Different than buying a bond, right? We look at the bond. The bond is a debt security. A stock is a share of the company. This is the Dow Jones Industrial Average from 1950 to 2017. Look at how far up this thing has gone. It's up at 25,000, right? So back when I was a kid, it was like, 1,500. Can you imagine? If somebody said to me when I was a college kid that the Dow was one day going to be at 25,000, I would have been like, yeah, you're out of your mind. That's like me saying to you, hey, one day the Dow is going to be at 250,000. How many would believe me? You would all say, that's insane, man. Financial intermediaries, institutions that borrow money from people who saved and in turn make loans to people who need money. Most prominent would be banks, right? They take your money and then they give it to other people who need it. Yeah? They take your money because you're trying to save to buy a car, and then they give your money to somebody who's buying a home. Other financial institutions, insurance companies, finance companies, pension funds, mutual funds, investment companies, they all do essentially the same thing. The idea is that we're moving money around the economy, getting it from people who have extra to people who need extra. Financial innovation, and I think I talked about this the other day, this is the development of new products and services. This is important for you because when you get out of Bonaventure and you go to work, you can be a change in the financial industry. We want to know major disruptions in the financial markets are characterized by sharp declines in asset prices and the failure of financial and other firms. So we want to learn about these things so that we can avoid, hopefully, it happening again. Money and monetary policy. Evidence suggests money plays an important role in generating business cycles. Recessions and expansions affect all of us. Monetary theory ties changes in the money supply to changes in aggregate economic activity and the price level. Let's talk about a really stupid example. Suppose you're all at Bonaventure and a helicopter comes around and just dumps $10 bills all over the place, right? Loads and loads and loads of them, and you guys are all hanging out in front of Hickey, drinking beer and playing Frisbee. What do you think if, since you all got extra $10 bills, as many as you could pick up, what do you think would happen to the price of beer at the Burton?
It would increase.
The Burton would see you coming and say, holy smoke, these kids just had a helicopter of $10 bills dropped on them, raised the price of beer. That's how important money supply is to our economy and economic cycles, business cycles, right? So the Federal Reserve is in charge of saying how much money should be out there. And they use interest rates as the price. That's why this is so important. That's why we're here, yeah? So why study it? Yeah, monetary theory is how much money should they drop out of that helicopter, and the price level is how much it costs to buy beer. Aggregate price level is the average price of goods and services. A continual rise in that price we call inflation. That affects everybody. There is most definitely a connection between how much money there is and prices. So here we have the money growth, M2 annual, and the business cycle in the United States. These don't always coincide. So the business cycle, the gray, is recessions. So it doesn't always show that money supply and recessions go hand in hand, right? Not every decline in the rate of money growth is followed by a recession. That's what makes the job of the Federal Reserve so difficult. Yeah, it's a real art to figure out, well, and often it's a very slow moving art, you know? It's almost like turning around an oil tanker in the ocean, you know? You start to turn it and it takes a long time before it actually turns. Aggregate price level and the money supply, you can see how they have been related, yeah? And you can see how much it's increased. The price level since 1950 or 1960, look at how much it's gone up, inflation. Average inflation versus money growth for selected countries. Notice they all have this positive correlation. So definitely money supply and inflation are related. Money and interest rates. Interest rate is the price of money. Prior to 1980, the rate of money growth and the interest rate were closely tied. But since then, not so much. The rate of money growth is still an important determinant of interest rates. So if we were in the classroom, I would like reach into my pocket and pull out, oh, I might be able to still do that. It's never about money. It's about the price of money. It's not how much money you have in your pocket. It's always about what is the cost of that money? Yeah? What is that money doing for you? Yeah, so don't think about it. We're taught to think about, oh, I have $500 in my pocket. I'm styling. Think about, I have $500 and it will get me this. Sorry about that. Okay. God, this is hard to do. Okay. Money growth and interest rates. So look at, up until 1980, you could see a reasonable trend around money growth and interest rates. But since 1980, 1985, this is much less clear. Yeah. So it makes the job of somebody who maybe works at the Federal Reserve much more complicated. And I'd like to point out that look at the interest rate in 1982. That's when I graduated from college. So it was like 15%, you know? It was like mortgages were 15%. Does anybody know what the current mortgage rate is, approximately?
$4%.
It's like 3 or 4%. It's like, I would say to my wife, it's free. Money's free. If you can borrow it, use it to make more money. Yeah? When interest rates were very low, my wife and I bought properties, rental properties. It's because money's free. It's like, you know, compared to paying it back at 15%, paying it back at 2% is nothing. Yeah? You can easily make 2% on your money. Monetary policy is the management of money supply and interest rates. That's conducted by the Fed. Monetary policy is that decision of how much money to drop off out of that helicopter onto St. Bonaventure. That's exactly what it means, right? It's adding money to the economy or taking money out of your pockets. They go around with another helicopter and suck it out of your pockets with vacuum cleaners. Fiscal policy is the government spending and taxation. So you learned all of this in economics, right? Excess expenditures over revenues is a deficit. Surplus, we almost never see that. Excess of revenues over expenditures. And then any deficit, they have to borrow. The government has to borrow. So fiscal policy is all about how much should we tax, and monetary policy is all about how much money supply should we put into the economy. Government surplus or deficit, look at this, it's almost always a deficit. See this little, what do you call that? Surplus between like what, 1996 and 2000? That was Bill Clinton when he was president, before you kids were around. It was his big deal, man. He was like, I balanced the budget, you know. He would come on TV and say, I balanced the budget. We have we're running a budget surplus in the United States for the first time in God knows how many years, you know. And then he would say, I did not have sex with that woman. Remember that? This was before your time. But that was what Bill Clinton's big claim to fame was. He had a budget surplus. can't. Oh, there we go. Yeah, so last time was in 1958. So foreign exchange, funds converted from one currency into another. Foreign exchange rate is the price of one currency in terms of another currency. The market determines the foreign exchange rate. So it depends, you know, if you, it's very important. If you were going to abroad, or should you buy goods that are made in America or buy goods that are made abroad? Or if you manufacture goods, should you sell them in America or sell them abroad? Why do we need to know about international finance? Because it's all one big market, yeah, throughout the world. The international system has a tremendous impact on domestic economies. Exchange rate affect monetary policy. So we have choice of exchange rate, yeah, some countries actually set the exchange rate. And some countries allow the exchange rate to fluctuate with the market. Capital controls. This is bizarre. My wife grew up in India, so they have property in India. But India will not allow you to take the Indian money out of India. So they can't sell that property and take the money, right? We want to sell that property in Bombay or Mumbai and buy a property in South Carolina. But you can't take the money out of India. That's a capital control. Imagine how restrictive that is to the growth of your economy, right? Overall, these are very important things. Here's exchange rates of the dollar. I want to see this. Hang on a minute. This doesn't make sense to me. Oh, it's just relative to other currencies. So it must be a basket of other currencies that they're comparing just the dollar to. The international financial system, we did this. Did we do that? Why is it there? That slide's there twice. I'm sorry. Money, banking, financial markets, and your career. So monetary policy, if you're interested in finance or you want to get into finance, monetary policy and understanding how the financial markets work is going to be huge. Okay, you need to know it. You need to know whether to borrow money. And even if you're just looking to buy a house, like I said, you know, my wife and I, when interest rates were really low, we bought a few houses. Now interest rates, when they go up, it's harder to buy stuff. It's harder to get a hold of money. How we will do this? Yeah, simplified approach to the demand for assets. In other words, we'll look at like supply and demand, right? Like you did in economics. We'll use the concept of equilibrium like you did in economics. Yeah, basic supply and demand. And we look for search for profits. Approach to the financial structure based on cost and asymmetric information. People know, some people in the financial markets know more than other people, right? And then aggregate supply and demand. The web is emphasized in several ways, and you'll see this in your textbook. I highly recommend you visit this, the Federal Reserve of St. Louis, the Fred. They have all kinds of economic data there. And additional in the chapter. Y'all know this, right? GDP, final value of all goods and services produced in a country during the course of a year. Aggregate income equal to aggregate output, right? Y'all learned that. Y'all learned that when you had economics with Wilson or Mo or whoever taught you, right? So we don't even have to spend any more time on that. Like Forrest Gump would say. That's all I'm going to say. Oh, real versus nominal. You know what this is all about, right? the value of final goods and services using current prices. The resulting GDP measure referred to as nominal. More reliable is an arbitrary base year. And most familiar is the CPI. Okay, I'm sorry, it's taken me a while to get used to pressing which buttons. You guys know real and nominal, right? I mean, like the nominal price of going to the movies is $100, but you may work at the library to supplement your college tuition and earn $500 an hour, right? So the real cost to you of going to the movies is like 15 minutes of work. Yeah? But the nominal cost of a movie ticket is, what did I say, $100. So that's the difference. Yeah? Real is much more important and relevant. Yeah, your real cost. Okay? So look, everybody has your Moodle in front of you and the chat and the problems, right? I'm gonna share my screen again, and so have a look at these problems right now. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There's 10 problems circled. I'm going to split you into 5 groups. And the first group do the first 2 problems. The second group do the second 2 problems. The third, and so on, okay? And take 5 or 10 minutes or something within your group. And then we'll all come back as a group and select one person from your group to answer the question for the rest of us. Okay? So that gives you a chance to hang out with your other people in the class and talk about the weather or politics or whatever after you've answered the questions. How many are we? 31. So what I say, 5 groups, right? All right.
The T-bills, was it just about the risk, or is it something else?
Yeah, I think that was
Enough for
mainly it.
this. Yeah.
All right, so man, this is just all about the risk, I think.
Well, you're a quiet group.
We're thinking.
Well, you're a quiet group.
We just thinking.
All right.
I agree with that answer that you just said. So
All right, so
That's right. Oh, okay.
yeah, you're gonna find out soon.
Yeah, I can't wait. I wonder how come you guys aren't making any noise.
We answered the first question. I think we're all just writing it down.
Oh, all right. I wanted to disturb you.
Wouldn't you buy more American made because foreign mades will be more expensive? Because it's saying that the foreign currencies
Yeah,
are
it's the same
worth
question
more.
from before, just flip the other way.
Yeah, you buy more American products.
Dollars worth more.
Because the other countries are more expensive.
No, but your dollar is worth more, so you can get more.
You know, if you buy more of foreign made stuff.
Foreign goods, yeah, because it's worth less because your dollar is worth more.
Oh, I read it wrong, yeah.
The complete opposite.
Yeah. Yeah. So who wants to be the person to talk? I don't care.
Go. Oh, we back in the chat.
You know what's a trip? You all don't fit on the same screen. So like when I'm taking attendance, if you're on the second screen and then you say your name, you pop up. Okay, who had one?
We did, or I did.
Cool.
So for the first question, each bond differs in interest rates. And so we talked in the beginning, like a treasury bill has like a 3-month one has a really low interest rate. And in times of like economic turmoil, interest rates will change and some bonds will be more appealing than others.
What makes them more appealing?
The rate of return.
Why do they have a higher rate of return?
Because, I mean, I guess when like there's like economic turmoil, the more risk there is, the less likely someone will
Right.
be willing to take on that risk.
Risk, yeah, you got to pay for the risk, yeah. Very good, thank you. How about number 2?
Kind of same thing, but if stock prices fall, corporate bond interest rates will go up. Also, businesses will have to maybe like find external funding to, I don't know, kind of like help them get back to where they were. Also, consumers might be more willing to invest if stock prices go down, if expectations are that they might go back up.
So that's great, thank you. Does everybody understand that the stock price reflects how new issues of stock in a company will be valued? Yeah, when a company issues new stock, they value it at the investment bank will value it at the going rate in the marketplace. So if a company wants to raise $10 million by issuing stock, and the price of their stock is relatively low, it's going to be harder to do than if the price of their stock was relatively high. Cool? All right, thank you, James. So we had group 2.
Yeah. So for the number 3, what effect would a rise in prices have on a consumer's decision to spend? So if those prices are going up, that might turn someone from like a saver into an investor. If like they have like a positive outlook on the market, they might want to start to invest if like they see a rise in stock prices. So it might put more money into the economy and people might spend some more because like the financial markets can provide like or they're supposed to provide like an outlook on like how different industries are doing.
Yeah, good.
Oh, sorry.
What was the next question?
Why are financial markets important to the health of the economy? So like you kind of talked about, like it can help businesses kind of expand by like issuing more shares and having people buy them, which is a good thing for the economy as businesses kind of grow and expand because it can create more jobs and things like that. And then also it can turn like, like I said earlier, they just kind of provide like an accurate outlook of like how the economy is doing with like some of the different indexes. But yeah.
All right, thank you, Ryan. I'm looking for something also, I'm looking for something more on the role of financial markets in the economy. Somebody want to jump in?
Yeah, I said they channel funds from those who do not have a productive use for them to those who do, which results in higher economic efficiency.
Yeah, exactly. Yeah, that's one of the main features of the financial markets, right, is to move money from people who have it to people who need it. Okay? What's next? I don't have next in front of me, so. By the way, thank you, Ryan and Brendan. Number 11?
Yeah, right here. So it asks, when interest rates decrease, how might businesses and consumers change their economic behavior? Well, we said consumers will borrow more. Like you said earlier, like you bought property and rental property, so you could rent it out. So people will do that. And then for number 12, it says, is everybody worse off?
Wait, what about the other half of 11?
So for businesses,
and consumers.
Yeah, consumers will, like I said, consumers will borrow more.
Oh, did you say that?
Yeah, consumers will
sorry,
borrow more. Like you said in your example.
Yeah.
Consumers will borrow like money and invest into like rental property and will make more on the returns than like the amount they have to pay back.
Gotcha. Thank you. I wasn't, man, my ears aren't working there very well. Sorry.
Sorry.
Okay. And then the next one?
It says, is everybody worse off when the interest rates are high? Well, some people will be saving more. So, I mean, I don't think everybody would worse off, because if people are, let's say, have a good view on the market and they're investing like into like a stock or something, they could have a higher rate of return.
Yeah, good. Thank you. Good. The investors would be better off. And what do we have? 2 more left? Oh, Jesus. Why do managers of financial institutions 13 and 15?
Yeah, we said that because the Federal Reserve affects like interest rates and inflation, those all have like important impacts on the profitability of financial institutions.
Yeah, great.
And then for 15, how would a fall in the value of the pound sterling affect British consumers? We said it would make foreign goods more expensive, so they would buy more domestic goods.
Yeah, exactly. That's great. Thank you.
Yep.
And oh yeah, you got to get to new classes. I mean, you got to go to other classes now. All right, then we should quit, shouldn't we? All right, everybody, let's meet again on Friday. And one of the things I want to talk about is how to go forward with this. So think about how this is working or what you'd like to see. And we'll meet again on Friday, okay?
Sounds good. Have a good one.
Thanks, everybody.
Thank you.
Have a good one.
Have a good one.